Well, welcome everybody to the 4-Star Podcast. Today's Market Explained, and we have a very special guest today with us, and he's a good friend and a business colleague and a very important guy in the financial planning world. We have with us Aaron Klein, and Aaron is the co-founder and CEO at Riskalyze, the company that invented risk numbers and empowers anyone to become a fearless investor. The company is headquartered in Auburn, California, and serves thousands of financial advisors and, of course, their clients. Aaron, hey, welcome to the 4-Star Podcast.
Brian, so great to be with you here.
Yes, we've been working together for years. We've never done an interview.
We have.
And so really appreciate your joining us. And so Aaron is the husband to Casey Stewart Klein and dad to
Right.
Spencer was born in South Korea. That's interesting.
That's right.
And then and Teddy were born in Ethiopia. We're going to have to hear about
That's right.
that.
We like to say we're just your typical average Korean, Ethiopian American family. You know, there you go.
Very interesting. Oh, that's great. So Aaron's spoken at conferences all over the country: Fearless Investing Summit, the T3 Advisor Conference, Tiburon CEO Summit, and many, many others. And all the conferences for the wealth management firms like TD, Pershing, Carson Wealth, United Planners, the big firms. And in addition to business success, Aaron and his wife have co-founded the Hope Takes Root, an initiative that uses vocational training and life mentoring to change the future for orphans and at-risk kids in Ethiopia. So that's all really interesting stuff. So Aaron, just give us a little narrative about yourself here for the next few minutes. We threw a bunch of things out there.
Yeah, for sure. And thanks for that. And super excited to be on here with you. We have a number of mutual friends, and then we get to intersect at different industry conferences and things like that. And I've so enjoyed getting to know you over the last years, and also having the opportunity to serve you and your firm as a Riskalyze user. We love that and are deeply honored by that. And so thanks for having me on. When I sit back and kind of look at what I've had the great fortune to work on over the course of my career, I started working in the afternoons after school for my dad. He was an entrepreneur, and it was a very tough business. It was like wholesale distribution of automatic gates and security equipment out there in Chicago, where you're located. One of his customers was the guy who did Michael Jordan's big gates at his house out there in Illinois with the big 23 on the gate. So we sold those gate operators that like automated those gates. It was pretty cool.
Somebody's got to do gates. Yeah, there.
Yeah, totally. So there's a lot of things that I learned from my dad, but among them were just the grit it takes to be an entrepreneur. And also that was a very low margin commoditized business, and just like relationships were everything in business. If you take care of your clients and do a great job for them, they'll take care of you. And so I kind of grew up with that ethos, and then kind of got into technology and was doing some different interesting things. Some things working out, some things not. Ended up spending a 4-year stint running global product for a division of an options brokerage firm, and I was struck by how crazy the average person thought about the concept of risk. And I was talking to a buddy of mine who was a financial advisor, and he said, if you think that's crazy, you should see how many of us financial advisors think about it. We just haven't really had the tools in our profession to understand who our clients are and match that up with the risk in their portfolios. And so that kind of led us to start Riskalyze. And, it was roughly about the same time that I was also becoming a dad for the first time. So that was, I'd become a dad a couple of years before that for the first time. But, we, as you mentioned, we've adopted 3 times. And so our first son, Spencer, was born in South Korea. Our daughter, Emma, was born in Ethiopia. And then on one of our trips back to Ethiopia, we started getting involved in this nonprofit work there. And on one of our trips back to Ethiopia, we met the kid who became the oldest Klein kid. That's Teddy. And so he is our sophomore in high school. Spencer is our freshman in high school, and Emma is our 7th grader. And they are amazing kids. And like I said, we're just your typical average Korean, Ethiopian American family.
Love it. Love it. Well, that's great. So then you founded this firm, and then, of course, you have a great idea, you create a system, and then you have an initial run at it, and then you realize here's all the things we can do to change it and make it better and better. So a bit about the evolution. I mean, I've seen it with clients, but how did that all develop, and then where is it today?
Yeah, we did start out with that core idea of like it should be easier and more effective for financial advisors to help understand who their clients are and match that up with the risk in their portfolios. But if you dig down a level deeper, it should be easier to understand risk as an investor, as a client, right? And make really good decisions. One of the things is I sit back and like look at the world. The problem with investing is that our psychology works against us, right? When markets are going, up, everything just feels easy and exciting and it's great. And we just want to put more money to work and put more risk on and like, let's go, 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 go. And then, when markets are down, we're feeling nervous and emotional and we're wanting to sell and take money out and take risk off and all these things. And, of course, what are we doing? Well, we're buying at the high and we're selling at the low, right? If we step back and look at how our psychology is driving us to make those decisions. And so, it just really struck me that like what really needed to happen in the world is we needed to equip financial advisors with a very simple way to give their clients a construct to understand and react to risk appropriately. If we can understand who this person is, and we can understand how they're going to react to risk, then we can build a portfolio that fits them, that they are going to be able to stick with in good times and bad. And they're going to be able to understand how, the right way to react to risk in that portfolio. And that ultimately is what can transform a fearful investor who makes bad decisions into a fearless investor who makes really great decisions. And at the end of the day, like that is the input that amazing financial advisors like you need. You need clients willing to make great decisions because that's the input that you transform into amazing financial outcomes, right?
Right.
You're great at what you do, Brian, but you're not a magician. You can't take a client who consistently makes bad decisions and turn that into a great financial outcome, right?
Right.
And so that was the core idea behind our software and what we were trying to build there. It's been really exciting. Today, we get to impact millions of American households through the tens of thousands of financial advisors that we have the great privilege to serve. And, our platform has grown a lot since then. It moved from being just risk to, portfolio analytics and proposals and investment research and trading and compliance. And so, we have a pretty broad offering for financial advisors today. But it all did start, and we still say we are a risk-centric wealth management platform because we really help advisors engage and meet their clients at the intersection of risk. And we think that it belongs there at the center of how advisors engage with clients. There are some people who have said, well, there's two things advisors should never talk about with their clients, and it's not religion and politics, right? They say it's risk and the short term. Because we don't want our clients getting fearful. We don't want our clients focused on the short term. And I go, but wait a minute, your clients react to risk in the short term. So if we don't build that construct to help them react to it appropriately, it's going to blow up on us at the worst possible time.
Right. And we need to look at the long term, but we're all like reacting to what's going on CNBC today. And like, well, where's my head? And
that's right.
That risk number. Let's go back to that model. What were we thinking when we did this?
That's right. And I love how you just phrased that, because I would tell you when we first started the company, we were a little bit naive. We said, we need to invent some technology here that is going to defeat confirmation bias, right? Confirmation bias is called, by behavioral psychologists, the mother of all biases, right? We see things in the world that confirm what we already believe to be true and what we've already decided is true, right? And so we spent the first 2 years of the company going, we're building technology to defeat confirmation bias. And about 2 years in, we said, it is impossible to defeat confirmation bias. And our goal is changing. We're going to harness confirmation bias to work for the investor. Because if an advisor like you has set up the client to say, this is the right decision for me, a risk 45 or a risk 68 or a risk 82 is the right decision for me as an individual, 6 months later, when there's maybe a little stress in the market, just like you just articulated, they can look back and go, wait a minute, I made the right decision for me. And now I can see that continuing down that path is the right decision because, this is the decision I already made. We're harnessing confirmation bias to make it work for the investor.
Yeah, we made a 10-year plan, but we're making a 1-week decision. Wait a minute.
That's right.
We need to go back and look at this again. What was our 10-year plan? And is this all part? And then what? I think it might be.
That's right.
So we're gonna hang in there when things get a little rough. And then the other side of confirmation, Aaron, is when you're nervous, then you call 3 friends and say, "Are you nervous? Are you nervous?"
True.
Now we tell, no, wait a minute. That's not right. Everybody's at the wrong time, which is another form of confirmation bias.
Yeah, that's right.
Well, that's great. Well, you've added a lot of really interesting tools to the toolkit at Riskalyze. Where do you see it going from here? Any new ideas that might be coming out in the next year or two?
Yeah, one of the exciting things that we've rolled out in the product that I love, and we're putting some more effort behind it to make it easier for you, easier to use, but also easier for the advisor to kind of see bigger trends in this. But it's this idea of what we call check-ins, okay? Right. And check-ins are a way, I don't know if you use it in Riskalyze. Do you use check-ins?
I haven't used check-ins yet, no.
Okay, so trust me, you're gonna wanna do this, you'll love it, okay? Because here's the idea. You mentioned already that the problem is that we're watching CNBC and we're getting worked up about CNBC. And literally what check-ins is it is a way for an advisor to keep their finger on the pulse of the client's psychology between meetings. Okay. In effect, it's how to measure the CNBC effect, And I have CNBC on in my office. I like CNBC, but the truth is it has an impact. It has an effect. And news, broader than just CNBC, but news out there is designed to kind of create that fear and that emotion, because that's what drives the eyeballs and the clicks and the money. Okay. So, the theory behind check-ins is, your client's psychology is at its highest the day you meet with them, and it has nowhere to go but down after that because of the news, right? And so what we're going to do, check-ins, is 2 very simple questions that are going to go out to your client, and it comes in on their phone, and they just tap their answer to the 2 questions. The first question is, how are you feeling about the markets, positive or negative? Right. Second question is, how are you feeling about your financial future, confident or anxious?
Okay.
With the combination of those 2, signals back to you, okay, that if it's green, that client is doing fine. Their psychology is good. You'll talk to them at the next meeting. Red, clearly they go to the top of your list. You need to reach out to them and help them out. And it's an easy way for them to ask for help without feeling stressed, about that, without feeling like a whiner, And then what's interesting is what it looks like if they're, let's talk about somebody who is red-green. So they're nervous about the markets, but they're confident about their financial future. Again, great testament to the work you're doing for them. Okay. But, you could reach out to them. You could not. It really depends. Okay. But now let's flip it. They're green on the markets, but they're red about their financial future. What they're really communicating there is they don't understand that you've got them well set up for success, or something about their expectations and needs have changed that they have probably not communicated to you. And it creates an opportunity for you to jump in there and say, if you're feeling good about the markets, but not feeling good about your financial future, that's very easy for us to fix. Let's fix it.
Let's fix it. That's great. Yeah. Well, and to be very frank with you, we do reviews every 6 months. Mm-hmm. And some folks stay on message and they remember everything, but people are busy, and some people are busy with family, work. And then all of a sudden, we have a bad market halfway between reviews, and we get phone calls, and some folks will react as if they've never heard the review discussion ever. And
the idea with check-ins is that, you probably appreciate the phone calls because those are the people telling you, I feel nervous, Brian.
Yeah.
I need your help. The ones you worry about, I'm sure, are the ones who don't call you. Okay. But they're still as worried. And so that's what check-ins is supposed to pop up to the top of your list and go, here's somebody who maybe isn't calling, but they might need a little bit of psychological help to reverse the CNBC effect.
Yeah, that's a great tool, Aaron. And we're going to start using that. Thank you.
That's awesome.
And anything else new that's coming out? Anything else you want to share with us?
That's a big, what we're really focused on there is like, how can we give you a little bit more of an easier way to see the results from the clients as they pop in? And how can we give you like a dashboard to show you trends there? There's a lot of other things we're doing, investing in a lot of the core technologies, try to make it faster to use overall, try to make it a little bit, faster and easier to use. There's some other cool upgrades that we're doing to a lot of our investment research tools just to make it easier for you to find things, but more to come. And hopefully you'll be with us at the Fearless Investing Summit later this fall, and you can see a lot more cool stuff come out the door.
That sounds great. Well, and then you have adopted some new partners as well. So the HG group and everything. Tell us why that happened and how's that benefiting risk investors and all that. Tell us a little bit about that.
Absolutely. So, when we started the company, first of all, like I was very much, I had done a startup before, hadn't worked out super well, had a lot of debt from that. Right. So I didn't have this thing called Riskalyze to tell me that like trying to do a startup on your personal credit card was not a good idea. Right. So there you go. So all this to say, I was very much paycheck to paycheck. Like I had, ideas, perhaps some level of skill to contribute and a lot of willingness to contribute sweat equity and hard work, but not money. So we raised capital from investors from the beginning, largely angel investors, you might call it friends and family network, a lot of financial advisors who, could kind of see that, who I personally knew at the time. You and I hadn't met quite yet, or you probably would have gotten one of those annoying phone calls from me. It would have worked out for you as it turns out, but that is hindsight.
That's right.
So all that to say, we raised that capital, and that was 2011. So that was now 11 years ago, right? And so that's what let us get the company started. Along the way, we raised a little bit of institutional capital from some different players. Our mutual friend, Jeff Carter, led a syndicate to invest.
Yes.
A firm called FTV Capital invested in 2016. So we had this, mix of different investors, early angels, some quasi-institutional capital, some institutional capital. And so, the company has been doing really, really well. It's been growing tremendously. And here we are impacting millions of households, through the tens of thousands of advisors that we serve. And, our early angels were coming to me kind of going, and this was in early 2020, by the way. And they're like, Aaron, it feels like we've built a really successful company here, right? And I'm like, well, yeah, we're doing pretty good. And they say, well, I was 75 when I invested and I'm going on 85 now. Like, when do I get to spend some of this money?
Maybe I need to. Right.
I thought that was a fair question, So we started thinking about it. Then the pandemic hit, and I said, guys, like, we're not going to do this in the middle of a global pandemic. So that kind of put the plans on hold for a year. But starting back up in call it mid 2021, we said, look, this is a great opportunity for us. The market is strong. The company is doing really, really well. Great opportunity for us to go and partner with a new equity partner to basically, this is what we did. The management team and I partnered with this firm HG and effectively bought out all the early investors. Nice. So whether those were the early angels, whether it was the quasi-institutional or the institutional capital, we just went and kind of like bought out all those early investors, and everybody did really, really well. Our earliest angels who put in the first dollars made like 50 times their money.
Yeah.
Our most recent angels made probably 7 times their money, and our institutional capital made about 4.2, something like that, X their money. So everybody was very, very happy and excited about that. And then, what I was excited about is HG is this $37 billion software investor that understands how, software companies scale. And, really was excited about not, a lot of times when you're looking at that kind of strategic process, you go, my company's going to get bought and it's not going to be the same. It's not going to have the same focus on customers that we've had before. It's not going to have the same level of innovation that we've had before. And what was different about this transaction is HG was like, we don't want to buy your company and run your company. We want to partner with this management team to accelerate this vision. And we want to invest in you and what you're doing, not buy your company and take it over. And I loved that message and was super excited to partner with them. They're very, very smart people who work with basically, 25 really, really successful software companies all over the world. And I'm headed in March to Europe to basically spend time with 25 other software company CEOs who are all dealing with different levels of scale and have gone before me with a lot of the growth of those companies that are a part of the HG family. And I just get to learn from that and take a lot of those best practices back and inform how we grow to serve and impact the financial advisors we love to serve.
Wow, that's really neat. That's really neat. So now you're part of a network, but yet you still have control of your company, which is really great.
Yep.
Awesome.
Exactly.
So we didn't talk really about your original motivation in doing this. It sounded like you wanted to be in a startup, and the first one didn't work, and this one has worked quite well. What was your original thought? Why did you develop this?
That's a great question. I mean, I would say that a big part of it was something I mentioned, which was just a bit being driven by the problem, believing that investing shouldn't be such a black box that's hard for people to understand, and that that people understanding risk could be a great driver for better investment success because people were not making bad decisions based on their psychology working against them. So that was a big part of the motivation. But you're right. Another part of it was just that I've always loved entrepreneurial business. I grew up in it, and I'd done a startup, that hadn't worked out so well, and then I went to work for this bigger company, and there were a lot of good things about the bigger company, but frankly, there were a lot of things that were just tough and bad about its culture, and it was one of those things where I wasn't too far into that company. I really loved the person I worked for. I love some of my teammates in that area, but there were just a lot of things that were fundamental about how that company worked that just led me to go, man, if I ever start another company, I'm going to do things a little bit differently. And so, it was kind of interesting because when we started Riskalyze, we started with some core values that, pretty much they've evolved a little bit. They're not carved onto stone tablets like the 10 Commandments or something, but our 9 core values are pretty close to the same of what they were when we started the company, March 1 of 2011. And people can read them. They're at riskalyze.com/values. We put them out there because it's really what we operate by. These aren't just things we put on the wall, integrity and teamwork and things like that, right? Integrity and teamwork are part of our values, but we talk about how we actually operationalize those. And so I would just say, to directly answer your question, it was obsession about the problem, but it was also, a desire that man, we could build a great organization and a great place to work, and that could make a big impact on the world. Yes.
And you really have. It's fascinating, and it's good to hear how that all worked out. One of the questions I like to ask folks is about, when you look back on your development, Aaron, and how you came to now be the CEO of this firm, and you have new investors, and you've got old investors that they've been able to get out, and you've created all this value. And if you ever had a conversation with yourself when you were 20 years old, what would you tell your 20-year-old self today, knowing what Would you do it again? What kind of advice would you give to
Yeah.
20-year-old Aaron Klein coming out of college?
Well, I definitely say to do it again. I'd also probably say, like, there's going to be, like a company coming along called Tesla, buy a bunch of stock or something like that. But I mean, in terms of advice, I'd probably say, look, there's no silver bullets a lot of the time. Like, don't get hung up trying to find silver bullets to problems. Like, sometimes you just got to put your head down and solve them with a lot of lead bullets, and hard work. The other thing that I think is true is that if you work hard, if you listen to customers, if you deliver a really groundbreaking product that exceeds their expectations, then you take care of them with great service. Like, the rest kind of takes care of itself. That's easier said than done, but that's really the core elements. If you're focused on that, if you think you can cut corners on service and stuff like that will catch up with you. If you think you can cut corners and just sell something that's like an inch deep, that will catch up with you. It's not going to build lasting value. Yeah. And then the last one, and honestly, I feel like this has been my mantra, because there have been, from the outside, and I tell the team this all the time, from the outside, we look like the Cinderella story. Like, everything is just goes perfectly for us. Inside, we know that we've got 99 problems, and, progress is simply that we traded out this set of 99 problems for a different set of 99 problems next year. Exactly. That's progress. But the biggest thing is just not to quit when it doesn't get hard. That's the number one thing I've learned as an entrepreneur. I can't tell you, like, the fraction of value that we would have created in this company if we quit when it got hard and when it looked impossible. We were 2 weeks away from running out of money in 2013 at one point in our history. And, it would have been very easy to go, this didn't work out. And we just refused to quit. And here we are, again, getting to have the impact on the world that we're having, because, at one moment in 2013 and a bunch of other moments in between, we just refused to quit.
Yes. Well, that's key. And that really kind of speaks to, your drive and your motivation and your desire to succeed and to make it work. So that leads me to the question. You must have had something in your background that kept you focused. We all know of a lot of startups, like you mentioned earlier, the early one that you invested in that didn't work out. And many startups don't work out, and many companies don't work out. So did you have any key mentors along the way that kept kind of pushing you along? Go, Aaron, go. Go, Aaron, go. Or here's some ideas. Yeah.
No, I think that's true. First of all, I have to count my dad. Like, my dad, his company was, I haven't calculated this recently, 16, I'm going to say 20, I think it was 25 years that he was running his company. That's a long time. No, a little bit less than that, maybe 18 years. But anyway, all that to be said, he ran his company for a long time. I helped him sell it to a larger competitor, when I was pretty young. And, nice. Again, I mentioned this before, but he just taught me so much about the grit that it takes, and just the never quit, even when it's hard. I have two other great friends that have been mentors to me, and they taught me two different and interesting things. One was my friend Brian, who, by the way, I think you may have met. He's the CEO of Redtail, and CRM for financial advisors.
Yes.
And when we were nothing, Redtail was the hot CRM for financial advisors, growing like crazy. And Brian was just super generous about saying, hey, let's build an integration. And, like, I want to put the risk number with a question mark, like, right on the contact screen for our CRM. And, like, people will discover that, and it'll be great for our users because they can, get great integration between Riskalyze and Redtail. And so he did that. And that was, like, massively helpful to us. And I just felt like, I remember asking Brian, I'm like, okay, so do you want, like, a revenue share for this? And he's like, no, like, I just love, like, so many people helped me when I was really early, and I just love paying it forward. And, that taught me to try to, I do whatever I can to pay it forward to other entrepreneurs in the space.
That always,
right. And my other one is my friend Phil, and Phil is an amazing guy who has, built a really successful company, not in technology, different space, and sold it. And what I love about Phil is that he refuses to retire. He calls it his refocusment. He just finds other things to work on that, that make an impact on the world. And he goes, I just don't really see a place in life for like literally just canceling everything and just going and sitting on the beach. Like I'm willing to take more vacations and do other things like that. But like everybody has a mission in life, and, refocusment is better than retirement.
Right. So just golf and beach doesn't work.
That's right. That's right.
Keeping moving in the right direction. All right.
That's
So one more personal question.
Sure.
Inside your head, so we can understand how you did it, and that might give some of our listeners the idea on how they can start something like this. Let's talk about books and movies. What are the books you've read, and any movies that you kind of outline what your mindset is?
Yeah. Well, I mean, a quick one on the movie side. I would tell you, like this still has some mythology in our company as well. One of my favorite films of all time is Apollo 13. With Tom Hanks. And there is, I don't know what made this come to my mind, but like, I call it the Apollo 13 question. That moment when we were, like not far away from running out of cash. It was a couple months before that, and we were at another inflection point that was just hard. And I remember like opening up a notebook page and writing at the top the Apollo 13 question, which is, what do we have on the ship that's good? Because, crippled spaceship, trying to figure out how to get it back to Earth. And you're just like, what do we have on the ship that's good that can help us achieve the mission?
Right.
And so anyway, I love that about Apollo 13. From a book perspective, there's a really interesting book that I read along the way called The Hard Thing About Hard Things. It's written by Ben Horowitz, who was an early executive at Netscape, and then founded a company called Opsware, and ended up selling that company to Hewlett Packard for like $1.6 billion. And, near-death experiences over and over again. And, went through the dot-com crash and like was 3 weeks away from running out of money, and took the company public with like, negative EBITDA and like, $10 million of trailing revenue, like just crazy, and saved the company with an IPO, right as the dot-com crash was happening, like just crazy stories. And one of the things he writes in that book, which I have reminded myself, some of those times when you want to quit, his line is, there's always a move. There's always a move. Yes. And your job as CEO is to figure out like what's the move? Because sometimes there's only one, but there's always a move.
It's always a move. Yes. That's fascinating. Well, great. Well, Aaron, this has been a great picture inside your company and your motivation, and learning about, how you've helped the financial industry and all the investors out there, but also just a great story about your life and how you built it. And that should give really a lot of entrepreneurs and people who are trying to build something, a lot more legs in deciding to stick with it. It's easy to give up when things get really, really rough. As you said, there's always a move. There's always a move to build something. It's very
awesome. Well, thank you so much for having me on. This has been a great conversation.
Yeah, thank you so much. Thanks for being with us here in the 4-Star Podcast. Today's Market Explained, and maybe we'll do a follow up with you in the future and get what's going on. And we're going to get right on that check-in program as well. Thanks again for being with us today, and thanks everybody for being with us today with Aaron on the 4-Star Podcast. Thank you very much.